Hello, everyone.
Hey guys.
Welcome to the sixth episode of Overthinking Cats, the Algo trading. And today we are finally going into the investments terminology and everything, right?
Yeah, the concepts and everything. It's going to be so much value in this episode. So let's get started.
Yeah. And this time we have changed our plan. So we're hoping for a shorter video, and we have actually gathered a very cool mind map. So with that, let's get started. So today we want to discuss about three main topics. What are the foundational concepts when we get into investing and finance? Like we want to learn them, the terminology, the concepts for equity investments and fixed income investments.
Mhm.
So let's get it started with foundational concepts. Uh, we want to talk about the core investment principles, then like their value changes over time, and risk and return. The core investment principles, let's get started with the first one. The first topic we want to discuss is security, and that is any tradable asset, financial asset, obviously. And we're going to talk about any kinds of this assets like what are stocks, bonds, options, and everything. But for now, uh, any tradable, if you can trade it and it's financial, it's an asset.
True. So an example for that would be when you buy a share of stock in stock market, like if you buy um, in terms of stocks, if you buy Apple, it's going to be a stock that you're buying. And basically you are owning the security.
So the next thing is investment, and like this is very easily like easy to understand. It's you put the money into any security and with hoping that it will generate income or profit.
Exactly. Like if you are buying a real estate for uh, $300,000, expecting it to be worth, let's say, $400,000 in 5 years, that is kind of investment, but in the real estate.
Mhm, mhm. So then, when you want to have investments, you have a collection of investments. You can invest in multiple real estates, multiple securities, as we saw earlier. So that collection, that basket of your investment, either it's owned by you, like as a person, or by an organization, like a trading organization or uh, any organization that is called a portfolio.
Correct. Like if you have a self-management portfolio, you're going to choose your stocks in your portfolio. But when you are using kind of managed investment, you are letting that organization to create a portfolio for you. For example, like um, Jane has a portfolio which consists of 60% stocks, 30% bonds, and also 10% cash. So
Yeah.
it's basically a mixed investment
Mm-hmm.
of several securities.
Mm-hmm. Yeah. So it's a diversified kind of thing.
Correct.
Then so you are we are going down, right? So we saw what is any tradable asset. You buy that asset. Yeah, the collection of those assets is called uh, invest portfolio, but the money that you put into that investment is called capital.
Correct. Like after saving $10,000, your capital to invest in the stock market would be $10,000. So basically the whole money that you put in, it's your capital.
Exactly. So with that, let's go over to see how the value changes over time. So when we want to talk about the value change over time, sometimes it's going up, sometimes it's going down, and sometimes the market itself is not sure, right? So Navi, do you
Right.
want to take a stab on these?
Yeah. So whenever there is an increase in the value of your asset, we are saying that there is appreciation.
Mm-hmm.
The opposite is depreciation. So, for example, as an example for appreciation, if you bought a house for 250K, then now it worth 350K. That's
Mm-hmm.
the amount that basically it has been appreciated. So there's a growth in your value. On the other hand, like if you buy a car for like 30K, then it might depreciate to 24K after 1 year, because basically your money depreciated over that period of time.
Mm-hmm.
And for inflation, like general increase in prices and fall in purchasing value of money. That means, for example, if inflation is 3%, 100 item will cost 103 next year. So that would be basically an increase in price or a decrease in the price. So we know that as inflation.
Mm-hmm. Mm-hmm.
And the last term here would be compound interest, which is the interest earned on both principal and accumulated interest. So that means, like, if you invest $1,000 at a 5% flat rate annually, year one you have $1,050, and year two you have 1,102.50, not just 1,100. So
Yeah. So because
that's the example for compound interest.
mm-hmm. Because it comes both on the interest you gain and the money that you already had.
The
Sure.
initial
Yeah.
value that you put in. Yeah.
Perfect. So let's get into risk and return. So what do risk and return mean, and what are we talking about? So risk is like, it's easy to understand. You have a possibility of losing some or all of it. So any possibility of losing is risk. Um, so like it can be risk at any level, right? Startup investments have high risk. Like some can fail completely and you lose everything. On the other hand, their return is the money made or lost on an investment. So we saw over here appreciation, depreciation, the value of a thing going up or down. So the return, that money which is increased, that amount of increase or that amount of loss, is called return. So a 10% return on 1,000 means basically you earned $100. And then there is a risk return relationship. So higher potential returns typically require like higher risk. You have to, if you're looking for like higher returns, it will also have potential of like losing higher amount of money. So government bonds offer like 2% minimal risk. Stocks might offer like 7 to 10% higher risk. So you can,
But there is a higher risk.
yeah,
Yeah.
you can lose money
So
as well.
basically, when you expect um, to get a high return on your assets, then for sure there is more risk attached to it. And like you need to keep that in mind, because whenever even when you want to create a like managed investment portfolio, then you're gonna keep that in mind. Like don't go with like a 30% gain because you are increasing your risk level. So that would be something that maybe you don't want to do. Maybe you want to keep your money. Maybe you would be happy with less, let's say, profit, but with a lower level of risk. So that's super important.
Exactly. Okay, so let's get into some actual types of these investments. The first category we want to look into is equity investments. And here we have stocks. So Naveed, do you want to take us on this?
Yeah, so for first one, we do have stock fundamentals. What's the meaning of stock and share? Both means like a unit of ownership in a company. So these words can be used interchangeably, and like let's say when you buy one share of Microsoft, uh, you have a partial ownership of the company. And also like for market capitalization, that means the total value of a company's outstanding share, how much the company worth in total. The formula is share price times number of the shares outstanding. And as an example, if a company has has 1 million shares at $50 each, its market cap would be $50 million. And there is another term here, float, number of shares available for public trading. For example, if a company has 10 million shares, but executives hold 4 million, the float is 6 million. That means like 6 million is available publicly. So are we still on the which category are we?
So we are still talking about stocks.
Okay.
We want to look at the types of stocks.
Okay. So the type of stocks by ownership rights, we have two types, common stock and preferred stock. The common stock is like basic ownership shares that typically come with voting rights, super important. If you own that share, you can vote for the company, for the elections in the company.
And decisions.
As an example, yeah, like common stakeholders of a company can vote on board members and major corporate decisions. So you basically have that right. For preferred stocks, on the other hand, they have higher claim on assets and earnings, but usually there is no voting rights. For example, if a company pays dividends, preferred stockholders get paid before common stakeholders. So if you are a common stakeholder, you have priority over the preferred stakeholders. That is again super important.
In terms of
moving
voting,
to the
right?
Yeah,
But in terms
exactly.
of dividend and everything, they prefer the stocks get paid before them. So you have priority in getting the money, but not voting.
Exactly. So for type of stock by company characteristics, number one, it is based on maturity and stability, which we have two types, two company types basically. If a stock is blue chip, that stock has a large, well-established company with a solid reputation. For example, Apple, Microsoft, and all giant high-tech companies, they are blue chip uh, type. So on the other hand, for penny stock, there is a low-priced, highly speculative stock, typically under $5. So basically, maybe most of the startups, or uh, as an example that we have here, a mining exploration company, which is trading at 30 cents per share. That is called penny stock. And we also have, based on price growth and prospects, for growth stock, we have, let's say, company expected to grow at a above average rate. And as an example, we have like Tesla, we have like Shopify, we have like Nvidia and stuff like that. On the other hand, value stock is a stock trading at a lower price. Examples are bank stocks trading below booked value.
This is related to
So
fundamentals, right? Based
yes,
on, we are getting to this like later, but I think based on the values and everything, they should have higher value, but right now they're having less value. So probably they're
that's
gonna
correct.
increase. All right. So then there are corporate events for stocks.
Do you want to continue this for this session, or we can continue?
Let's finish, at least we can finish the equity investments.
Okay. I think our call is going to end in 2 minutes.
Yeah, I think we'll finish in 2 minutes.
Yeah, okay, go ahead.
So, corporate events for stocks. One is IPO. So, first time a company, private company, maybe in a startup, is offering sales to the public, that is called an IPO. So, initial public offering. When Facebook sold shares to public in 2012. Sometimes the startup comes, does an IPO, then later they issue new shares because they see, okay, they have growth and everything, so they're issuing additional shares. For example, Tesla issuing additional shares to raise capital for expansion, and capital meant investment money.
All right, great. So the last category is income from stocks. If you open that, we have dividends. That means the payment made to you by a company because you are a shareholder, and you're basically getting paid. For example, Coca-Cola pays 44 cents per share quarterly to shareholders. So it depends on the company how long they want to pay you. And
Or even if they pay or not. Some
even
companies
if they
don't
pay or
have
not,
dividend.
it's not something that all the stocks do, all the companies do. It depends on them, on the board, and if they pay you monthly or yearly or quarterly, it's up to them.
Mm-hmm.
Then dividend yield is the annual dividend payment as a percentage of share price. The formula is the annual dividend per share divided by share price and times 100.
It's percentage.
Yeah, for example, like $2 annual dividend on a $50 stock would be 4% yield annually. So that is also something that you might want to consider when you are buying stock.
Awesome. So with that, today I think we covered lots of great topics, starting from some um, core investment principles and concepts, the value change, risk and return definition, then what are stocks, what market capitalization, types of stocks based on different things, and income from stock.
Yeah, so basically many basic concepts, which was super helpful for us, and we hope you guys enjoy this content as well. And that's the beginning of our journey.
Yes.
So um, if you can, Ali, you can share this with our audience
Mm-hmm.
and let them use such a valuable, what do you call it, mind map?
Yes, it's a mind map.
Yeah.
Okay, cool. Thank you everyone for joining. See you next time.
You guys.